Good afternoon, everyone. My name is Paddy Andrews. I'm a Director of Private Clients here at Metis Ireland, and joining me today is our Chief Investment Officer, Declan King. Big thank you for everyone for logging in. We have big interest in this today, which is great. Testament, I suppose, to what's gone on over the last couple of days in investment markets. I'm conscious it is a Friday afternoon, kids finishing up for Easter, and we are in the midst of a heat wave as well. So we do appreciate people taking time out to log in and join us today. We will keep this to roughly 25 to 30 minutes, guys. If some of your colleagues or family members couldn't make it, we will record the webinar and send it out early next week as well. And again, conscious everyone's time. It's a beautiful day outside, but it's a pretty topical thing we're going to go through this afternoon. So the title of this webinar was actually a Q1 investment review, looking back on the first 3 months of 2025. But it's fair to say the first 10 days of Q2 have been pretty hectic, Declan. So probably the best place to start, and tariffs, I suppose. First things first. What is the rationale, I suppose, behind the Trump administration's implementation of a tariff war? What are they trying to achieve? And I suppose more importantly for clients on the call today, why has there been so much volatility in the investment markets for something that is usually priced in?
Yeah, we're looking forward to doing this webinar. I think we could have done this differently every day. We chatted earlier on the week.
We've had to update things.
It's been one of those weeks. Yeah, I think we updated the last few slides before we came on here. So this will be interesting to see how this goes. In terms of the conversations, it could take any direction, but no, I think it'll be hopefully beneficial. So look, just to start off, I think it's important that we explain the tariffs. What are they, first of all, right? And essentially, every country exports and imports goods. So when you import a good or you export a good to another country, generally there's a tariff you have to pay to sell your goods in another country. So tariff, another word for tax. Tariff, I think, would probably end up on one of the most used words of the year. It's probably one of the front runners for most nuanced word of the year or most different used word of the year. But they are essentially just a tax, right? Now, why so much noise about the tariffs right now? Well, first of all, I think, again, take a little bit of a step back and you look at the US market. The US market has to do something here, right? The US market has been in a massive deficit, and the budget deficit is at all-time highs at 1.3 trillion now. So that means essentially if the US is a business like any other, money in versus money out, it is clearly taking in less money than it is giving out. And that means something had to be done. So if we look at how this US administration ran its whole campaign, based on balancing the budget was one of the big things underneath all of the noise and maybe the glamour that came with it, right? But underneath it all, it was. So that's when DOGE came in, the Department of Government Efficiency, and Elon Musk got involved there and leading that up. And that was essentially to try and reduce the spending part of the budget. And then the other side of it was tariffs. You can do this a number of different ways. You could have increased the inflows in a number of different ways. Trump has always been very bullish on tariffs going back the last 40 years. So no surprise that was the avenue he took, right? So essentially, this is balancing the budget. And I think it had to be done at some point. And you'd have to admire the administration, at least for taking on this challenge, because it's something that other administrations in previous times gone by have just kind of ignored. And it's just got worse and worse and worse. And I'm sure you've watched number of different financial movies and documentaries over the years around Ponzi schemes and pyramid schemes. And look, what's going on at the moment is money coming in is less than money going out. And eventually that is a problem. And when that is a problem is always been hard to say. But when that is a problem, then it becomes a problem. And it would have spiraled out of control. So I think there is something to be admired that they're at least trying to do it. Now, your last question, which is the most important part, really, is why has markets reacted so crazy and a lot of panic over the last kind of 10 days? And that is largely down to two things. If we look at where the tariffs were at the start, right? This is kind of showing what the US effective tariff rate going back since 1930. And you can see since World War II, effectively, that has started to come down. And it has continued to come down over that time period. And this is something that has always annoyed Trump. If you listen to interviews he did back in the 80s, he's always thought this has been too low. So no surprise, and the whole campaign that he ran, everyone that voted for him, tariffs was a big talking point. And if you look at the blue line, which is the middle of the three lines there, that was the campaign promises, roughly what the kind of tariff effective rate would be. That had calmed down quite a bit since he got in. And the end of March announcements would have indicated somewhere in around 7.5%, as you can see in the chart there. What caused the majority of the volatility in markets on April 2nd was the extent. You can see actually they went and they announced much more severe tariffs than were expected. And I think alongside that, the calculation that went into calculating these tariffs was questioned. And I think I did listen to David McWilliams' podcast on this, and he described it as if his students in Trinity did this calculation or tried to apply tariffs in this way to some sort of school project, class project, he would have failed them. So a very interesting way, to say the least, of how we actually apply these tariffs. And I think that caused a serious lack of confidence in the administration and the US economy in general. So the two main reasons, the extent of the tariffs and how they were applied, caused a lot of the uncertainty. Because as you said, there was a lot of this tariff discussion already priced into markets.
Yeah, like we look back, you mentioned in kind of end of February, early March, he announces tariffs around the biggest trading partners, obviously in China, Mexico, Colombia as well. He rolls back on them. The haphazard nature of the calculations of how we just applied these tariffs to some jurisdictions where there's not even people living there kind of showed his hand. He needs to make deals with trading partners. And that's ultimately his objective. And that made the news on Wednesday quite surprising that he just rolled back without any deal being struck. Markets reacted accordingly to that as well, with that kind of positive bounce we got through, up 9 or 10% in a couple of hours. So we've seen that increased volatility. If we were to look and trying to predict what markets at any time, but particularly with President Trump and his advisors involved, what would be the worst case scenario going forward around the reciprocal tariffs, and how would that impact markets? And on the flip side, what would the best case scenario be for global economies, for the US, and ultimately for our client portfolios and investment markets?
Yeah, I think the worst case scenario, I think like nothing happening in action is just as bad in this scenario as let's say bad deals, because the big issue here is the longer this drags on, the tariffs effectively will just get passed on to the consumer. Because right now, in the short term, nothing is actually going to get moved. So obviously he's talking about manufacturing and he's talking about pharma, which is obviously a little bit more sensitive to ourselves. It takes a lot of effort to move these plants into the US and move them anywhere really, from a regulatory perspective, safety perspective, all that type of stuff, but also on the job side of things. So he keeps preaching that wants to bring, better jobs back to the US, bring back manufacturing, all that sort of stuff to certain parts of the US. US unemployment is at pretty low levels at the moment. So it's not like we're getting a huge employment glut in the US. So if you manage to bring all these jobs back, some of them are high skilled, the qualifications aren't there, so there would be training required. And then some of the jobs, as you mentioned, coming from countries like Vietnam and Cambodia, looking at Nike and Lululemon and these companies that have been name checked, bringing those businesses back, it's unlikely that people are going to want to do those jobs, because there's already better paying jobs in existence in America not being fulfilled at the moment. So all of this would lead to, inaction and no deals, probably result in kind of a bump in inflation. While it would be short term, would be extremely meaningful in that the price of goods would just shoot up and consumer would be affected. Best case scenario, I didn't see Wednesday coming, like most people, I'm sure. Rowing back on it was probably the best case scenario. I think if Europe and other countries, China definitely weren't going to go down this route, but if other countries and other regions had struck a deal pretty quickly, I think that would have been good for markets in the short term, but probably not good for that economy. So if Europe had made a quick deal, probably would have been bad for Europe in the long term. So the fact that he's rowed back probably was the best case scenario in the short term for markets. Who knows, over the next 90 days, there'll be a lot more activity, I'm sure.
I think that's a key thing as well. The tariffs haven't been postponed, or they haven't been cancelled. They're just postponed for 90 days while potentially deals are worked out. Like, trying to predict what will happen in 90 days time is obviously very difficult as well. We would have had a lot of people on this call, communication with myself, with yourself, Declan, with other private client managers around Metis, both in Dublin and in Limerick. I think what it has shown over the last couple of weeks, and our investment philosophy clients literally kind of laugh when we tell them this because it hasn't changed and it will never change. We What happens in markets over the course of a 10-day period, no matter how volatile it might be, should not influence your investments when drawdown is not for 10 plus years. And our message won't change, hasn't changed, isn't going to change today, and won't change into the future. Your investments, whether it's through your pensions, your direct investments, corporate investments, if your money is set up correctly at the start for longer term investments, you will expect volatility, maybe not to the levels we've seen in the last week or so, but that is normal with long term investments. And I think the best thing a lot of our clients did, nearly all of our clients did, was listen, as awkward as it might be, or as frustrating as it might be to see valuations coming through day on day, but stay in your seat and trust that your longer term investments will come through this volatility. And I think that was so evident between Tuesday, Wednesday, and Thursday, even this week alone. So that message of just sticking with your process and your plan was proven massively over the last couple of weeks as well, which I think is important to note. I'm conscious that we constantly preach it in Metis about blocking out the noise and being a disciplined investor and kind of like being really focused and diligent around your planning. We've just spent the first 12 minutes of this webinar talking about the last 7 days, so maybe we're contributing to some of that short-term viewing. This is a quarterly review, and outside of the first 2 weeks of April, what were the other big stories? We spoke I think, the last week of January at Trump's inauguration, just around that period of time. And we tipped some big things that would happen in the investment markets. This was coming off the back of a sensational return in 2023 and 2024, and even a good start to the year as well. What were the other big stories outside of tariffs over the first 3 months of 2025?
Yeah, well, we flagged, the growing weight of the US in global markets. At the time, started the year in the developed world, US was up to 73%. You looked at, the Mag 7, the 7 companies, which we'll show in a second, were a third of the index. And we kind of said, look, this is all a bit much in terms of, the general diversification you get in markets is not there at the moment in the global sense. We kind of highlighted that as a concern at the start of the year. And we kind of said that the 4 main drivers of returns would be AI, which we'll come back to, geopolitics, which we've touched on here, and I'm sure we'll come back to again. And then the other 2 were the earnings of the large companies and inflation, right? Inflation has been kind of a moot point at the moment, but that might have its day again. Earnings is going to come in the next few weeks, so really hasn't impacted the first quarter that much. But it's all been about the geopolitics story around Trump in the last kind of 6 weeks. But if we rewind ourselves back, this is a quarterly review, as you said, and we rewind ourselves back to the end of January when DeepSeek was kind of entered the race for a kind of AI supremacy over that time period, and that had a huge impact to markets over that period. So in particular, I think that really started, you mentioned, a pretty good start to the year. I think this really was the trigger for the kind of downturn, and then tariffs and stuff and other news media took over and kind of exacerbated that kind of sell-off. But if we look at the performance of markets over the last 2 years, what I've shown here is I've shown the performance of the S&P 500, which is the US, the MSCI World, Japan, Europe, emerging markets, and China. And the blue bar on the left is the performance of these regions over the last 2 years, so 23 and 24 together. And then up until last night, the orange bar is the performance year to date, so from the 1st of January to yesterday. So as you can see, a lot of the sell-off has been in the larger, I suppose, outperforming companies or countries over the last couple of years. And it's no different when we look at factors. So if we look at, let's say, large cap growth, which is the Mag 7 companies over that period, which would include the Mag 7 and other large cap kind of growth companies, you can see that obviously did unbelievably well in the last 2 years, contributing 85% to the indexes. But that's down 19%. You look at value, which is on the other side, which didn't really benefit that much. That hasn't been hurt as much. And I think it's kind of an important way to look at markets right now in terms of where do we see it right now. And I think the market is now in a much healthier position as a result of this sell-off. So we've seen a lot of the higher value companies come back a bit, and we've seen some of the other regions that have struggled in the last couple of years outperform a little bit. And we've seen some of the factors like value doing okay. So a lot of the areas that we were concerned about at the start of the year, we're less concerned about now. So this is why I've kind of put this up as, is this an old-fashioned sell-off? And while it was triggered by AI and then triggered by tariffs, it looks very much like, if you never heard of any of these stories, it looks very much like a traditional sell-off where things that were overvalued have come back a little bit, and things that were undervalued haven't been hurt as much. And it seems a little bit more practical and fundamental than maybe all the noise dictates. And the chart on the left, just to show what it shows, is we would have said that the US was overvalued at the start of the year versus long-term averages. That's the gray bar, let's say, on the left-hand side here, the gray squiggly line. And you can see the valuations have come down a little bit. The green line is the top 10 companies over that time period, and that has come down quite a lot. So you can see that valuations are now, I wouldn't say all-time lows, nothing like that, but much more attractive than they were at the start of the year, making the kind of investment or universe at the moment a healthier place to look at.
Isn't that, we had conversations toward the end of last year with clients, obviously around this factor in terms of now a good time to invest, markets at an all-time high. It was nearly the S&P 493 and then the Mag 7 as outriders themselves. Like you mentioned, there's more balance to this now. Does it create, I suppose, for clients, and this is the conversation around trying to time investments, which we are absolutely against. We understand you just need to have plan for this, align your investments to your longer term plan. You shouldn't be dipping into the markets, for 6 months or 9 months at a time. That will never be the philosophy. But what advice are we giving? What should clients look forward to over the next 3 to 6 months in terms of valuations, in terms of maybe surplus capital on their side? What should they look out for over the coming months?
Yeah, I think I'm going to start with this slide, right? In terms of trying to say, like, the big thing that people look at the moment is to say, is this different, right? And what this, you're not meant to actually read this slide. This is to show a kind of a bit of a mess on purpose.
Thank God, my eyesight is bad, Dick, as you know.
So this shows the last, there's been 30 drawdowns since of greater than 5% in markets since 2009, right? And what all I'm trying to show here is every one of them has a narrative. All the drawdowns are on the left, and when they were, and all of the narratives are on the right. We just think this is just going to be another narrative as to what the drawdown is, right? This will appear, this drawdown that we're experiencing now will appear, who knows when it'll end and how steep it'll get, but this will appear on this document like everything else, and markets will continue to go up. That is our view. And I think one of the lessons that we learned this week, and a kind of a reminder, this is a slide that we've used in the past, which highlights the impact of missing the best days over an investment period. So people think, I invest for the full year, I get I got 10% returns. But people actually kind of don't fully realize this. Often the way the market works is it tends to jump, and there's a bit of volatility. So a lot of the returns can happen in a single day or over a couple of days during that year. Timing these is impossible, but missing them is hugely problematic. So if you try and time the market, the consequences of actually getting the timing wrong is fairly severe. So this chart shows that if you are fully invested in the US market from $1,000 from 1990 all the way to 2023, so 33-year time horizon, your 1,000 would have turned into 27,000. Obviously, great story. If you've missed the best one day, so one day over that 33-year period, your 27,000 is now only 24,000. You missed the best 5 over that whole 33-year period. It's now down to 17,000. So it just shows the impact of trying to time the market. And really, there's no need. Like, I think if anyone saw this number and said, over that 33-year period, you like 27x your money or 26x your money, whatever it is, you would take it. So why try and time the market? And I think that's, especially as you mentioned with Wednesday this week, anyone that was moving money this week, it was very dangerous and potentially missed out on a 10% gain over a few hours over that time period.
One of the other key, I suppose, events that we would have ran last month only, we had the fortune, the Dimensional Fund Advisor CEO, Gerard O'Reilly, a fellow Waterford man like yourself, Dick, flew over to join us in both Dublin and Limerick for events. So it was a really great conversation between you guys, and we had a lot of clients at both of those events. And one of the most striking things he said, this was, markets were obviously becoming really volatile. This was just pre-tariff announcements. But he spoke about his views on the markets. He was always optimistic, that you should be excited by what's happening in the markets, because ultimately you're backing the greatest companies around the world to create value going forward. And it was a cool way to explain the benefit of investing in the markets for longer term investors. And I think it really struck a chord with ourselves as well. We've seen in the last 2 weeks, I've had conversations with people on this call, is now a good time to come into the market, is now a good time to come out of the market. I think we need to look at it always through the lens of, if you have surplus cash available, personally or through your business, yes, okay, the market is probably at a bit of a discount now, but if you are going to use that money according to your longer term plan in the next 12, 18, 24, 36 months, it is not a good time to go into the market. And just because a lot of the noise that we've seen over the last couple of weeks maybe creates opportunities in terms of better values, as you mentioned, Declan, your investments should always and will always be through Metis Ireland aligned to your longer term plan. And in terms of Gerard O'Reilly's message, your conversation with him, is that re-emphasized again over the last couple of weeks, or is there any sort of?
Yeah, it was definitely a very calming voice. Probably more calming voice than I have to talk clients down in this environment. I'm sure he did a great job himself. I would encourage people to go back and listen to that. Actually, it's not time sensitive. Does talk a bit about tariffs, but not in any great context. So it's not time sensitive. I encourage people, if you haven't seen it, go back to the YouTube channel and take a look, because he explains this a lot better than I do. So I think I agree with you, right? When you say this is short term, definitely not, right? This is not what this is about. This is, I think we've got caught up a little bit as well with certain clients calling us this week, trying to get into the market quickly. I think people need to also understand that, the time it takes from getting to your bank account into the market can also take a bit of time for account openings, lots of different reasons. So having money ready to invest is important, I suppose, if you want to have it and to invest. But that's not what it's about. It's not about trying to get into the market really quickly at the moment. Trying to time this, as we said, it's going to be almost impossible. But what we can do is we can look back and say, well, look, historically, when markets have had a drawdown of, what this chart shows is 0% drawdown, which is your kind of standard market. Then you're looking at when markets have drawn down by 10%, 20%, and greater than 20%, what has the future returns have been after that sort of an event? So if you forget about all the noise, what historically has a sell-off done for future returns? And if we go over to the right-hand side, so each year has 4 bars. One is the 0% drawdown, 10% drawdown, 20, and greater than 20 over a 1, 3, 5 year and 10-year period. And as you can see, the further you go out, we look at the 15-year, for example, the difference of investing after a 10% drawdown is fairly significant, right? So versus investing kind of on a normal time. So while it's not what we don't advocate ever trying to time the market, now that the market is down, it is a good time to invest historically, and it's not really a time to panic. It's more of an opportunity than it is in terms than the time to panic. And if we look at people tend to run to cash around these big crisis events. So if we look at, I've listed some of the kind of more recent crisis over that time, over the last kind of couple of years. And what the gray bar shows is the 1 year performance after that crash. And the blue bar shows the 3 year performance. This is a 60-40 portfolio. So a fairly balanced portfolio of 60% equities, 40% bonds. And as you can see, over the 3 year period, the market has always gone up over after those crashes. So again, it's an opportunity. It's not a place to go and run and sit in cash. It's actually an opportunity. You can be diversified, invest to your own timeline, invest to your own risk profiles. This is why it's shown a 60-40. And you can see there's a lot of success out there after these type of events. So it's an opportunity more so than a kind of a sign to run to cash.
Yeah, we spoke about drawdowns being a disciplined investor's best friend. And that's, I suppose, the role of, we're conscious there has been a lot of noise. We're conscious valuations have been quite skewed over the last couple of weeks. And for a lot of clients on the call today, if you're still uncertain or want to have a chat, please reach out to your private client managers. For people who are not clients of Metis, you can reach out to Metis directly. We can have a chat with you around those type of things. Reacting to these market swings is not a good thing. You need to have a conversation. And as you said, Dec, investing to your own timeline is the key. And that's, they say, the investment philosophy at Metis Ireland is not changing and will not change on the back of this. But the data and the evidence that we look at suggests that, okay, we expect more volatility, it's fair to say, Declan, over the next couple of months when the tariff, I would say, resolution, but this is going to be an ongoing matter. what would you, for the key takeaways before we wrap up and let people off and enjoy the sunshine, what's some parting shots, I suppose, for everyone on the webinar today?
Yeah, I'm going to finish with this slide. This is the slide I finished with at the last webinar. Not a great slide, actually, in terms of quality, but I said I'd be consistent. I was going to redo it, and then I said, no, I won't. The reason why I'm showing this slide is essentially, look, a lot has happened in the last 3 months, and it always does. You know, market's always noisy. There's always lots going on, right? But the messaging also doesn't change. So like while everything has changed, nothing has really changed. We said at the start of the year, rebalance your portfolio. It still exists right now. Equities have sold off quite a bit. Bonds have done okay. If now your portfolio is a little bit tilted too much in bonds and not enough in equities, maybe you might look at rebalancing your portfolio and putting more in equities. That argument still stays the same. Block out the noise. While it seems like this week, since Wednesday, everyone's got a bit of a break from the news. But I don't think that's the case. As you said, this is a temporary pause on the negotiations that are going to come over the next few months. It's going to get particularly noisy. And the last point then is invest to your timeline. And this is the key, really. This is, if you're trying to time this to try and make a quick few quid on the markets, I think, look, it's going to be very difficult to time this. And it's not what we would suggest is a good use of your short-term funds. However, if you've got money sitting on the sideline that you don't need for an extended period of time, then you're looking at your balanced portfolio, you're looking at getting into the equity markets. For the long term, I think there's definitely some opportunities there. Short term, I just don't know in terms of the volatility. I'm sure it'll go up and down. I'm sure people will make money on it in the short term, but trying to time it would be extremely difficult. But in the long term, I think it's probably a healthier market now. From a fundamentals perspective, obviously talk of tariffs and all that may change that slightly, but from fundamentals perspective, much healthier than we saw at the start of the year.
Perfect. Well, it's 3 minutes to 1. A wrap up that may be the wrap up for every webinar we do when it comes to our investment philosophy. Despite what is going on, investing to your timeline is essential. So listen, a massive thank you to everyone for taking time out to join us. Keep an eye on the Metis Ireland social media channels and LinkedIn and our YouTube channel. Recording of this webinar will be out very early next week. And as mentioned, for any existing clients, if you're unsure of anything or want some specific details around your own portfolio, please do reach out to your private client managers. We're here to help. That's our job. So thank you, everyone. Thank you, Declan. Enjoy the rest of the good weather, and thank you for giving your time this afternoon.